Welcome to the Trending Report, brought to you by USA Financial. The Trending Report is a series that aims to focus on the trend lines rather than just the headlines. Each episode features commentary around the state of the market, as well as other factors that may impact your personal finances. The host of the Trending Report is an investment advisor representative of and securities are offered through USA Financial Securities, member FINRA SIPC, a registered investment advisor. The Trending Report is educational and not intended as personal financial advice.
Hi, this is Kevin Roskam with USA Financial, and this is your September Trending Report. Excited to be here in the month of September as the seasons change. And here in West Michigan, fall is certainly upon us. In fact, today we are experiencing our fourth coldest day on record for the month of September. It's supposed to be an average of 78 degrees here, and it is currently going to reach a high of about 62 degrees. Now that's interesting, and how does that relate to our trending report and what we're going to talk about? Well, it does, because even though today and the next several days is going to be cold, it doesn't mean that we're done with warm weather for the year. You always have these people who that first day where we get a little bit of a chill think that, oh no, summer's over, it's all done, we're into fall, and they see a trend where a trend doesn't exist. They see a couple of cold days, a dip in the forecast, and they believe that it's time to get all the winter clothes out. Well, whether it's because I don't want winter to come and I'm in denial, or it might be because I've been on this earth long enough to know that a couple of cold days at the beginning of September don't mean snow's around the corner. It's important to understand not just how the weather works, but how trends work and how dips and certain cold days don't mean the seasons are changing. And of course, it's the same thing in the stock market. Talking about the trends for this month, I found a couple of interesting slides that I wanted to share with you. The first is just like a couple of cold days here and there are normal. Stock market corrections are normal too. What we're looking at here is the average number of corrections per year. And so if you look at starting on the larger side, I suppose, the left side of the graph, what we see is a dip in the market of 3% or more, on average, happens about 7 times a year. And by the way, this is analysis based on the S&P 500 going all the way back to 1928. A mild correction, where the market drops 5% or more, that happens on average about 3.5 times a year. A 10% correction, averaging about once a year. And then when we get to severe corrections, we can see that those things don't happen as often. Now, why is that important? Because sometimes when we see a bad day in the market or a couple days in the market, or we see a mild correction of 5% in the market, we can think that the sky is falling. We can think that, oh no, here we go. Here comes the point where I'm going to lose 20% or 30% or whatever it may be. When in actuality, it is not a trend. It's a mild correction. One of the things that we need to be reminded of in a year like this year, but really over the course of time, is that when we look at risk management and we hire risk managers, what the purpose of a risk manager really is, it's to avoid the severe corrections, to avoid the bear markets. And they won't always get those things right either, depending on how quickly they happen and the severity of time that it takes to get from the top to the bottom. But the point of risk management is not to miss the dips or the mild corrections. Risk management is meant to avoid the catastrophic. And sometimes in years like this year so far, We've seen mild corrections. We even, in April, saw a moderate correction. And some of the risk management strategies that we have available avoided some of that moderate correction. Some didn't. But the point of risk management is not to miss the dips. If you've heard me talk before, you know that volatility is the cost of growth. You have to experience some volatility to see growth in your portfolio. We just don't want to see the severe corrections. We want to do our best to avoid those types of situations. And so stock market corrections are normal. Cold days coming into the fall are normal, but it doesn't mean that the opportunity for growth is over. Another thing we're focused on for September, of course, is the Fed meeting coming up in the next week or two. Now, all hints point to the fact that the Fed will be decreasing interest rates. They'll be dropping them. Most experts say about 0.25%. A lot of experts also say that that drop has already been priced into the market. And so one of the things I think that's important to remember about the Fed and interest rates is that the Fed's acting on rates, whether they're raising rates or dropping rates, that's never a leading indicator of the economy. It's typically a lagging indicator because the Fed moves slowly by design, whether that's, whether we're frustrated or not with how the Fed moves, they do move slowly. And they typically move as a result of economic conditions, not to lead economic conditions. And that's what they typically do. And so what you're looking at here is, I think it's kind of a cool chart to see what stock performance around Fed rate cuts looks like. And so first of all, the blue line is the average Dow Jones performance 12 months prior all the way to 12 months later. And again, this is based on the history of the Dow Jones since 1914. The orange line that's the most recent time period around the Fed rate cut, which was the last rate cut was on September 18 of 2024. And so what you see, first of all, around that cut, you see in that orange line, recent history, you see volatility, especially about 6 months out after the rate cut. What I think is really interesting here is the gray area. The gray area is the expected Dow Jones performance with a 70% probability range. So even experts don't know exactly where the stock market is going. But what they do put into place is the 70% probability of where it will be. Now, what's interesting is, of course, the blue line is right in the middle of that probability because the gray is based on the averages and it's based on history. The other thing that's interesting about probability is if you look at the orange line, you see that there have been times prior to the rate cut and after the rate cut where the actual performance of the Dow has fallen below the probability. Probability is not certainty. And so as we look to the upcoming Fed meeting and the probability and assuming that the rates are going to get cut, what we see is the market already moving in a positive direction before rates get cut. And so I think some people are assuming, when they cut rates, the market's going to take off. Well, that's typically not the case. If it's already running in the right direction, it will continue. But the Fed rate cut, as I said before, is a lagging indicator, not a leading indicator. And so we've seen that the trends have been positive, and we think they'll continue to be positive. But it doesn't mean, as you know, that performance happens in a straight line. And so, for a quick review of the trends, This is what the S&P 500 over the last month has looked like. Again, volatility. Volatility, but it started a month ago lower than it is in this chart. This one and every chart that I show is always such a great reminder that performance doesn't happen in a straight line. Last month I said if you would have known at the beginning of 2025 that by September 1st the S&P 500 was going to be up 10% for the year, would you have turned everything off and left your accounts alone and not paid attention to what's been going on in the market? And generally, I think people would say, yeah, that's what I would have done. But we know that there's volatility. And that volatility causes us the opportunity to be emotional. The dips, the mild corrections can cause us to get off track. Even when we use risk management, it can cause us to question, why are we using risk management if it's not working on the exact day that I wanted to get out and the exact day I wanted to get in? But we know that performance doesn't happen in a straight line. And in order to avoid some of that volatility, we will avoid some of the upside depending on our risk tolerance. This is the trailing 1 year of the S&P 500. Again, you can see that the performance is up now versus 12 months ago. But again, there's been volatility. And finally, the 5-year, of course, continues on the right track. Long-term investing requires short-term grit. It requires the ability to stay invested in the strategies that you've committed to over the short term. You cannot experience long-term success if you're not invested for the long term. Whether you've hired money managers or whether you have a mutual fund portfolio, whether your risk management style is just straight asset allocation, or if it is more momentum-based and more active-based. The only way long-term investing is successful is if you allow it to move through the short term to get to the long term. And so what we see now, in anticipation of the Fed cutting rates, in anticipation of some of the results of the tariffs coming in terms of some higher pricing and supply chains moving around, we may see mild corrections. We may even see a correction. But what we have to see is discipline in our investment approach. And by looking at the trends and understanding that the long-term trends are still positive, we should be able to control our short-term emotions to the point where we can see long-term success. This is Kevin Roskam. This has been your September Trending Report. As always, thanks for listening, and I'll see you next month.
Thanks again for listening to this episode of The Trending Report, powered by USA Financial. We invite you to visit usafinancial.com to find out more about our work with independent advisors and their clients all around the country. Any projections, targets, or estimates in this report are forward-looking statements and are based on the firm's research, analysis, and assumptions. Due to the rapidly changing market conditions and the complexity of investment decisions, supplemental information and other sources may be required to make informed investment decisions. All expressions of opinions are subject to change without notice. Clients should seek financial advice regarding the appropriateness of investing in any security or investment strategy discussed.